Jennifer and Roy from Smart Plan in Jupiter, Florida. Today we are going to talk about a scientific, academic approach to investing called modern portfolio theory. The portfolios offered through Smart Plan utilize this and other Nobel Prize winning approaches. Today we will discuss modern portfolio theory and how our investors harness its power.
Well, we're going to be talking about Dr. Harry Markowitz. He is best known for his pioneering work on modern portfolio theory, in which he studied the effects of asset risk, return, correlation, and diversification on probable portfolio returns. Let's talk about risk. Kind of the chance that an investment's actual return will be different than expected. This includes the possibility of losing some or all of the original investment. Now, risk is usually measured by calculating the standard deviation of the historical returns, or the average return, of a specific investment. How does it vary around the average? Now, what's a return? Well, the return is a gain or loss of a security in a particular period. The return consists of the income and the capital gains on an investment, and it's usually quoted as a percentage. Another area is correlation, and in the world of finance, a statistical measure of how two securities move in relation to each other is the definition of correlation. And we don't want a portfolio that everything correlates, so it all goes up at the same time, it all goes down at the same time. Think about when it's raining out. If you owned a store, what would the odds be that you're going to sell a lot of suntan oil? Not too high. You're going to sell umbrellas, raincoats, and rain supply. But when the sun's out, what happens? People will buy the suntan oil and not buy umbrellas and raincoats and things like that. So you have sales both when it's raining and when the sun is shining. So it's best to be diversified rather than just to have the one asset class. Now, diversification is a risk management technique that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within that portfolio. Let's take a look at an example. Let's create a diversified portfolio. If we took the period from 1970 through 2013, just look at portfolio 1. This portfolio is S&P 500 index. What that is the 500 largest stocks in the United States. So we are not diversified internationally. We are not following value, and we're not picking up any international stocks because this is only U.S. large. We don't even have U.S. small. So, but our return is about 10.5%. And for that 10.5% return, our standard deviation, represented by a number, it's not a percentage, the number is almost 17. So on a line, the 17 would be farther to the right than 0 or 3%. Okay, so it's just a number going along a scale. But let's look at portfolio 5. When we diversify this from just U.S. large and we reduce that to about 7.5%. And what else do? We pick up 40% of the portfolio is in fixed income, 5-year government bonds, and 1-year fixed income. So we have reduced the volatility in this portfolio by putting in more fixed income. And what else did we do? Well, we went outside the United States. We went to the Europe, Asia, and Far East Index. We picked up 15% of that. We also stayed in the United States, but we took some and we put it in U.S. small companies, 7.5%. We also went internationally and picked up 15% of international small stocks. And we also took another 7.5% and stayed in the U.S. and picked up small cap value. And we also took 7.5% and put it into large cap value. So we did diversify the portfolio, but we didn't do a great job on the diversification. But in this example, look at the results of just doing this. What is our annual return? Almost 11%. And where were we in portfolio 1? 10.5. But the big change is look at the standard deviation. 11.7%. 11.7 on our scale from 0 on up. We were at 17. Now we're at 11. So what we've done is we've made the portfolio a little more efficient by reducing the risk and actually improving the return. And this is using modern portfolio theory. It's a theory on how to construct a portfolio. It was put together by Harry Markowitz and a couple of other people. And it shows how to construct a portfolio to maximize the expected return for any given level of risk. What this kind of means is, depending on how much risk I'm willing to take, how can I maximize my return? Or another way to look at it is, what can I expect my return to be? Let me emphasize that risk is an inherent part of a higher reward, but not all risk is the same. Let's really diversify the portfolio, all right? And this is what we do. We take different asset classes, okay? We carefully choose the proportions of various assets. For example, we have in this aggressive portfolio that we use, we have Canadian small companies, we have fixed income, we have money markets, we have United Kingdom, we have Asia Pacific small companies, we have international large cap, we have international small cap, we have international value, we have emerging markets value, we have emerging markets small, emerging markets, small companies, we have large companies, we have U.S. small cap, we have U.S. small cap value, we have U.S. large cap value. We even have micro cap in the portfolio. These are the smaller companies in the U.S. We have intermediate government, 1-year fixed income, 2-year global fixed income. We have fixed income, we have U.S., we have international, we have emerging markets, we have value, we have growth. We are following the 3-factor model that we're going to discuss in another presentation, but we are following the Markowitz efficient frontier. This portfolio, when it's put together, has over 12,500 unique holdings in it, in a total of 19 distinct asset categories, representing 45 total countries. So unique holdings means we're counting a company one time if it's in the portfolio. If it's in U.S. large and U.S. large value, it's counted only as one time. So modern portfolio theory is one of the most important and influential economic theories dealing with finance and investment. We accept that if we're willing to take on more risk, we should expect a higher return. Because if an investor is taking on more risk, he or she is expected to be compensated for doing so. I mean, we could go out on a golf course and take a lot of risk. We could stand out there during one of those fantastic lightning storms that we see here in South Florida with a golf club above our head near a tree, and if we got hit by lightning, we would be taking a huge risk. But what's the return? Not very good, okay? So, but if an investor is taking on more risk, they do expect a higher return. And that's what we want to have happen with the portfolio. So they need to be prepared to take on more risk, especially if they have the time remaining to do that, which is the rest of your life. Now, Harry Markowitz stated that a good portfolio is more than a long list of good stocks and bonds. It is a balanced whole that provides the investor with protections and opportunities with respect to a wide range of contingencies. Well, in my words, this means you want a portfolio that will work for you both in long term, no matter what's going on in the market, because in the end, it all balances out. Now, some of the people that contributed with Harry Markowitz when he won the Nobel Prize in 1990 was William Sharpe, and he's best known for the Sharpe ratio, which is a way to examine the performance of an investment by adjusting for its risk. And then we have Merton Miller, and he was responsible for modern corporate finance theory. MCFT is a theorem on basic capital structure, arguably forming the basis for modern thinking on capital structure. Now, one of the things that I would not want to do would be to try and figure out the mathematics on this stuff. It would be a disaster if I were doing it. Matter of fact, it wouldn't happen. But they won a Nobel Memorial Prize in economic sciences for this work. And Harry Markowitz's work went back to 1950 when they didn't even have a computer to tell whether or not he was right or wrong, or the database with all the data in it. But how would you define the perfect investment? Well, I kind of think it would be having no risk but a big reward. Well, modern portfolio comes close to the reality of this kind of investment. So, but you're not going to find one that has no risk and a high return. This is the efficient frontier in a graphic form. Optimal portfolios should lie on this curve known as the efficient frontier. Our goal is to identify your acceptable level of risk tolerance represented by standard deviation, the bottom line, going from 0 on the left up to 20 in this graph, and to find the maximum expected return for that level of risk. Now, modern portfolio theory suggests that it is possible to construct an efficient frontier of optimal portfolios which, based on risk and return, would fall somewhere on this line. A portfolio above this curve is impossible. A portfolio below the curve is not efficient because one could achieve a greater return. Remember the example that we had earlier, back where we took the return of the S&P 500, which was out about 17, and the return was about 10.5, and we actually increased the return to 11, and at the same time we reduced the standard deviation down to about 11 or so. So we made it more efficient. Now, it may not have fallen on this efficient frontier because it was just a breakdown of flat percentages. It was not an optimal portfolio. Okay? That's why it takes a lot of engineering in order to get an efficient portfolio. So what we're looking at on the left side is the compound return, and we're looking at the standard deviation on the bottom. And our goal is to be on that line, okay?
Can you explain what standard deviation is?
Standard deviation is kind of the deviation around a mean. In other words, if a asset class has had a return of 18 over the past, or 18, of 12 over the last 20 years, or 80 years, either one. What is the deviation 94% of the time that the annual return is not at 14 or 12 or whatever the average return is for that area? So it's the amount of times that it falls within a percentage of that average. We can count on that. Will it be 100%? No. So the annualized standard deviation is really a measurement of volatility. And the risk percent, okay, can be called standard deviation. So the numbers on that bottom line are not percentages. Okay. So where do you think that your portfolio falls on the efficient frontier? Well, if you're with us, you are on the efficient frontier, or as close to it as we can get. But if you're not, let us show you. Call us at 561-744-9547. Schedule an appointment, and let's get together and see where are you on the efficient frontier.
And how do we do that? How do we know? How can someone know if they fall in this frontier?
Well, every company falls in a particular asset class, and we know what those asset classes have done since 1926. Some of them internationally, we don't have the data back that far. We had World War II, kind of changed things over in Europe. So some of the asset classes we have data on later than that. So we can take a look and find out where your portfolio sits. What asset classes are the stocks that you may hold? Where are they? What is this type of fixed income? Is it long-term, short-term? Are you taking on unnecessary risk? We can run it through the software. Trust me, I don't know the mathematics to try and do this. Fortunately, we have software that can determine using Morningstar, and we can determine how much risk are you taking in your portfolio, how well diversified is it, where do you fall on the efficient frontier, and you need to know that. I mean, you don't want to wake up some morning like the S&P and I got risk of 18 and my return is, for that level of risk, should be so much higher. So, because the one thing you can never get back, time. It's gone forever. So we need, if your portfolio is wrong, we need to get it corrected. It's not efficient.
So if you haven't had an analysis done or an MRI on your portfolio, give us a call. We'd be happy to assist you with that.
And one of the things that we do need to mention in order to be within compliance are we do have the end notes for this. Jennifer can scroll through those to back up what we have in the presentation.
If you'd like a copy of the end notes, just contact the office. Thank you. See you next time.